Next up, we have Kyle Fertilowski, and he's doing a presentation on price action technical analysis. Let's hear it, Kyle.
Yeah, so what's up, guys? This is my presentation on price action technical analysis. So as you can see right here, we do have a chart, and this is of Bitcoin, which is like a cryptocurrency. So I'm not even trying to explain that to you guys. It's probably way too confusing for y'all. But right here, as you can see, the stock is going down. So that's normally when we want to buy the stock, like price goes down, we buy. But then yeah, so that's a big part of it. All right, so the next part is when the price goes back up. That's kind of when you want to sell the stock so you can make mad bread. So that's basically everything that goes in price action technical analysis. It's pretty simple stuff if you ask me. So yeah. Well, you got something to say, Teach? You got something wrong with my presentation or something?
Yeah, Kyle, I do have something to say. Do you even know what price action technical analysis is?
Yeah, I do know what it is. Do you even know what it is, nerdlinger?
Yeah, Kyle, I do know what it is. Price action technical analysis is when you look at current price information to make accurate predictions about price movements in the near future. First of all, we'll be going over candlestick charts, which are the absolute foundation of technical analysis, which is why they're so important for day traders to learn about. Now, as you see, we have these lines at the end of the candles, which are called wicks, and they represent the highest and the lowest price within the time frame. And we also have the body of the candle, which represents the difference between the opening price and the closing price during the time frame. Here we have a green candle, and as you can see, the opening price is lower than the closing price, and that means that the price of the stock went up during the time frame, and that is called a bullish candle. On the other hand, we have the red candle, and the opening price was higher than the closing price, which means that the price went down during the time frame, and that is called a bearish candle.
So next we have trends, and trends are very important as they can make our trading decisions more accurate and easier to execute, and they are a good method for beginner traders to use when beginning to trade. And you always want to trade with the trend rather than against the trend. So first we have uptrends, which are made up of impulsive moves, which are big jumps in price, followed by pullbacks, which are corrective drops in price. Now, it can be pretty hard to determine when the market is in uptrend. So what we like to do is we like to look at the most recent pullback point, the lowest point of that pullback. And we like to wait for the next pullback, and we like to see if that number, the lowest point of this most recent pullback, goes below that number. And so if it does go below that number, we can determine that the market is no longer an uptrend. However, if it stays above that number like this chart right here, we can determine that it is an uptrend. So next we have downtrends, which are once again made up of impulsive moves and pullbacks. However, this time the impulsive moves are drastic drops in price, while the pullbacks are slight increases in price. Now, to calculate whether or not the market is in downtrend or not, it is pretty much the same as the uptrend. However, you want to look at the highest point of the pullback and look at the next pullback and see if that highest point is higher than that. And if it is higher than that, then that means that the market is not in downtrend. However, if it is lower, like this chart right here, you can determine that it is in downtrend. And finally, we have range, which just means that the market is moving sideways and that there's no real uptrend or downtrend. It's just kind of going in the middle. So
now we'll be going into supply and demand, which is really important because it drives all price movement. And we have two important laws that we're going to look at: the law of supply and the law of demand. Supply is the amount of people willing to sell an asset, and demand is the amount of people willing to buy that asset. The law of supply states that there's a direct relationship between the price of the asset and the amount of people willing to sell the asset. So as the prices rise, the supply will rise, and as the prices drop, the supply will drop. This is because sellers have a minimum threshold at which they'll be willing to sell their asset. So if the price is very high and above that threshold, there will be more people willing to sell, and if the price is low and below that threshold, then there will be less people willing to sell. On the other hand, we have the law of demand, and this states that there's an inverse relationship between price and demand. So as the prices go up, demand will go down, and as the prices go down, demand will go up. And the reason for this is because buyers have a maximum threshold at which they'll be willing to buy the asset. So if the price is high and above that threshold, then there will be less people willing to buy. And if the price is low and below that threshold, then there'll be a lot more people willing to buy. Now, going off of the laws of supply and demand, now I'm going to talk about the role of the imbalances between supply and demand and how those drive price movements. The two main things you need to know is that when supply is greater than demand, the prices will fall. And when demand is greater than supply, the prices will rise. And I have two examples to show you how this works. So let's say we have JMD Incorporated at $10. And at this price, we have 100 people willing to sell, but only 50 people willing to buy, meaning that the supply is greater than the demand. In order for the sellers to win over more buyers, they're going to need to decrease their prices. So as the prices fall, there's going to be less sellers willing to sell at the lower prices, but more people willing to buy at the lower prices. And prices will continue to fall until the supply and demand levels, the number of sellers and the number of buyers, evens out. And this level is when the price will stop falling, and this is called support, which we'll talk about in a moment. Here we have when demand is greater than supply, the price will rise. So we have this pretty much the same example here of JMD Incorporated at $10, but instead we have 100 people willing to buy at this price and only 50 people willing to sell. So in order for the buyers to win over more sellers, they're going to need to increase the price at which they'll be willing to buy the asset. So as the prices go up, there's going to be less buyers willing to buy at the higher prices and more sellers willing to sell at the higher prices. And once again, the number of buyers and the number of sellers, the supply and demand, will even out. And at this point, the price will stop rising, and this is called resistance.
Next, we will be going over support and resistance, which are 2 points where the stock is expected to bounce off of, and these can help us to determine when we should enter or exit a trade. First, in uptrend, we want to look at the most recent peak of the most recent impulsive move, and we want to set that as our resistance point. And on the next impulsive move, we want it to break through that resistance line, and we want the pullback to be the same as our previously set resistance point, which will turn it into support, and that will mean that the price will continue to go up. When we're looking at downtrend, we want to look at the lowest point of the most recent impulsive move, which we'll set as the support. And on the next impulsive move, we want it to break through that line, going lower instead of higher like an uptrend. And we want the pullback to be at the same point as the support. And this will mean that it will continue to go down. Now, we have previously stated that you do not want to trade in a downtrend. However, you can use an advanced technique called shorting, which we will not be going into in depth in any series. And that is essentially just placing a bet that the stock will go down. And once again, we will not be going over that.
Next, we'll be going over candlestick patterns. Specifically in this case, we're going to be talking about candles that tell you how bullish or bearish the market is within a given time frame, which is represented by one candlestick. So here we have the most bullish and the most bearish candles. In the most bullish candle, you see that the opening price is down here at the lowest point, and the closing price is up here at the highest point, showing that the buyers have complete control over the price in this candle. And on the other hand, you see that the price opens here at the highest point, and the price closes down here at the lowest point, showing that the candle is very bearish and the sellers have full control. Next, we have the second most bullish and second most bearish candles. So the price opens here, and then the sellers show some control by pushing the price all the way back down to here. But the buyers overcome all that selling pressure and push the price all the way back up to here to make the candle bullish, showing that the buyers have a lot more control than the sellers. And here we have the price opens here, and the buyers are able to push the price all the way up to here, but then the sellers overcome all of that buying pressure and push the price all the way back down to there, making the candle bearish, showing that the sellers have more control than the buyers. And here we have the normal bullish and the normal bearish candles. And in this, you see that the price opens here, and then the buyers push the price all the way up to there, and then the sellers regain a lot of control by pushing the price all the way back down to there, and then the buyers regain more control by pushing the price up to here at the closing price higher than the opening, showing that the buyers still have more control than the sellers, but there's more balance between both sides. And here we have the price opening here, and then the sellers push the price all the way back down to here, but then the buyers overcome that, push the price up here to the top of this wick, and then the sellers regain back most of that control and push the price down to here at the closing price, showing that the sellers have more control than the buyers. And here we have the neutral bullish and bearish candles, which are pretty similar to the normal bullish and bearish candles, but they show more control between each side, or greater balance of control between each side. So we have the price opens here, and then the price gets pushed up to here by the buyers at the top of this wick, and then the price is pushed back down to here at the bottom of this wick by the sellers, and then the buyers regain most of the control, but not all of it, by pushing the price all the way back up to here, making the candle slightly bullish, but not that much. And then here we have the price opening here, and then the sellers push the price to here, but then the buyers regain a lot of control, and push the price back up to the top of this wick, and then the sellers regain a little bit more control by pushing the closing price below the opening, showing that the sellers have a little more control but not that much more. And lastly, we have the least bullish and the least bearish candles. So here in the least bullish, where the price opens all the way down here, and then the buyers show a lot of control by pushing the price all the way back up to here. But the sellers also show a lot of control by being able to overcome most of that buying pressure and pushing the price back down to here, a little bit above the opening price. So we see some control by the buyers go up to here, but then we see a lot of control by the sellers as well going to here, showing a pretty even balance between both sides. And then we have the opening price here for the least bullish, least bearish candle, and then the sellers push the price all the way back down to here, showing some control, and then the buyers overcome a lot of that control, but not all of it, by pushing the price back up to here, just slightly below the opening price, showing that the pressure is even between both the buyers and the sellers.
So next we have some candlestick patterns that will either indicate reversals or breakouts in the market. First we have the bullish engulfing pattern, which shows the large green candle engulfing the smaller red candle, which may indicate a reversal into an uptrend. And similarly, we have the bearish engulfing candle pattern, which shows the larger red candle engulfing the smaller green candle, indicating a reversal into a downtrend. Next we have the kicker pattern, which is normally used in range markets. And so the bullish one shows the very large green candle next to some smaller red candles, and this may indicate a breakthrough into an uptrend. And the bearish kicker shows a large red one next to some smaller green ones that may indicate a breakthrough into a downtrend. And finally, we have the bullish doji, which indicates that there may be some slight resistance towards a downtrend, meaning that it could move potentially into an uptrend. And then finally, we have the bearish doji, which shows that there is some resistance towards an uptrend, indicating that it may move into a downtrend.
Next, we'll be looking at some important chart patterns that can tell you about the movement of the price in the near future. Here we have the bullish and bearish flag patterns. In the bullish flag pattern, you see a strong uptrend followed by a little bit of downward consolidation, and then you see a breakthrough in resistance back into this strong uptrend. In the bearish flag pattern, you see a strong downtrend followed by some slight upwards consolidation, and then once again a breakthrough in that support, dropping down into another strong downtrend. And here we have the bullish pennant pattern, which is once again a strong uptrend followed by some small sideways consolidation, making this kind of sideways triangle shape, and then it'll break through there and go back into a strong uptrend. And then here we have a strong downtrend with the same type of thing, that sideways consolidation pattern making a triangle, and then you see a breakthrough in support dropping down into this strong downtrend. Next we have the bullish wedge pattern, or this is called the falling wedge, where you see this kind of sideways but downwards triangle shape where there's a strong downtrend and then some slightly downwards consolidation, and then you see a breakthrough in that support into a strong uptrend. And then here we have the rising wedge, in which there's a strong uptrend and then some slightly upwards consolidation, and then you see a strong breakthrough through that support level into a strong downtrend. And lastly, we have the two head and shoulders patterns. This is the inverse head and shoulders because you can see that there's the two shoulders here and there's the head down here, but it's upside down. So that's why it's called the inverse head and shoulders. So you see a strong downtrend, and then it breaks through the support level down to here, and then it bounces up and it hits off of this previous support level, making it now a resistance level. Then it drops back down to here, bounces off it once more, makes another pullback, and then it breaks up into a strong uptrend. And the regular head and shoulder pattern is pretty similar, except you see a strong uptrend and then going through this resistance level, and then you see it bounce off of this resistance level, which is now becoming a support level. Then it goes up, and then a stronger pullback down to the support level again, pulls back up one more time, and then a strong drop through the support level into a downtrend. A chart that you can use, and it's called the Fibonacci retracement tool, and it just really works really well alongside price action. And what this tool does is it essentially tells you points at which the market is really likely to react and cause the price to bounce. And these price points are really useful for giving us points of entry into a trade.
So to activate this indicator, you're going to go over to this little box over here and click this little arrow, and then just click on the Fibonacci retracement button right there. And then to go to the settings, you're going to click on one of the lines that pops up, go to the settings here. You're going to deactivate all of these values besides 0, 0.382, 0.618, and 1, and 0.5. Now we set 0.382 to this light green, 0.618 to dark green, and 0.5 to normal green, and everything else you can kind of just choose whatever you want. So basically, we call the range right here from 0.32 to 0.618 the golden zone, because this is where the price is most likely to bounce. So 0.32 is a medium pullback, 0.5 is a good pullback, and 0.618 is a strong pullback.
So how you're going to use this tool is you're going to put it on the chart once you see a pullback forming after a recent strong impulsive move. So here we see the strong impulsive move, and then we see this pullback here, and around here is when we'd start putting the tool on the chart. And when you're putting it on, you would put you would start at the bottom here at this really low part here, and you would extend the box to the high of the previous impulsive move. And then you'll wait until the pullback gets into this golden zone here between 0.32 and 0.618. And then that's when you'd look to enter the trade. And if you do enter the trade, then you would ride it and you would exit once it reaches the target level here at 0, which is at the top of the previous impulsive move.
So our first enhancer is going to be the Williams fractal indicator with a period of 10 to identify points of high probability of reversal. And this helps us to know where to place the Fibonacci retracements. You're going to start the box at the red fractal right here, and you're going to want to extend it out to the green fractal right here.
Along with this, you can also add the anchored VWAP indicator. And you would start this indicator at the red fractal that's in the golden zone. So where the price is likely to bounce back from that pullback and go back up is what the red fractal indicates. So you'd start the anchored VWAP there. And if it falls within the golden zone, it can act as a level of support. And when it bounces off of that level of support, then that would be a time you would look to enter the trade. Also, instead of that, you can also decide to use the 200-day exponential moving average. And just like the anchored VWAP, this also can act as a support level if it falls within the golden zone. This case it doesn't, so it's not as good as the anchored VWAP would be in this case. But if it does fall within the golden zone, you can use it as a support level, and once it bounces off that support level and continues to rise, that's when you would look to enter the trade.
So finally, if the price drops below this 0.618 level, that can be an indication of a downwards continuation. So this could be a good place for a stop loss. And if it goes above this 0 level up here, that means that it's crossed the high of the previous impulsive move, which could become a level of resistance, meaning that is a good target to take your profits and sell the stock.
In this video on price action technical analysis, we went over the structure of candlesticks and trends.
And then we went over key levels, which includes the laws of supply and demand, along with the levels of support and resistance.
We went over a multitude of candlestick and chart patterns, which can help you determine when or when not to invest in a company.
And last, we went over a tool called the Fibonacci retracement, which we can use on a candlestick chart alongside price action technical analysis to make better trading decisions.
All right, guys, I know. The rumors are true. I did switch outfits in the middle of this video, and I'm sorry. Sincerely, guys, I'm sorry. So I'm going to be doing everything I can to make it up to y'all in the next couple of videos. So, sorry. Profit number 1 out.
You are not number 1, bruh!